Having a look at the market, we've come so hard so fast. What do you think of the market at the moment and what strategy?
Julia, we aren't finding a great deal of value at the moment. Having said that, and by that I mean that it appears that stocks have run very hard, and at the great quality end they ran early. So what we're seeing at the moment is a lot of the rubbish catching up. Companies that arguably don't deserve to be up 11 or 12% in a day are rising 12% in a day. In fact, I can tell you that some of those companies, their internal organisation are absolutely shocked by the change in price for their companies. So we think we're at the sort of tail end of the rally, and we'll have a pause. What happens after that will largely be dependent on whether or not valuations continue to increase. But at the moment, we think they've caught up to valuations. There isn't a great deal of value left. There's a little bit left. But that doesn't mean that market won't keep running, and it's pretty bullish at the moment.
Okay, so we do have our first caller on the line. We've got Brett from Sydney. Brett, welcome. What's your question for our panel tonight?
Oh, hi, mine's regarding cash converters.
Sure.
At the current price, do you think I've missed the boat, or do you think it still represents good growth going forward and fair value right now?
It's a good question, Brett, because Cash Converters is a stock that's done very well throughout the past year. It's up more than 100%, and in fact the stock has been reaching all-time highs just recently. So having a look at Cash Converters, and
look, I have to confess we own the stock. We've owned it for some time, so we've certainly enjoyed the rally that everyone can see on their screens. The results came out, and we thought they were excellent. And we think the results are going to result in an upgraded valuation. So in other words, the valuation has gone up. We still think there's a little bit of value left in it, but not nearly as much as there was. So in answer to the question, have you missed out? You've missed out on a lot of it, but there's still a little bit left. We're also excited about the fact that there's a cyclical turnaround going on in retail, and we've noticed that since about October. One friend of mine is the owner of shopping centres around Australia, and he told me back in October that there were many of his tenants reporting higher turnover. So that gave us a signal that retail was improving. We've now seen this week sentiment improve as well, so that's going to help a business like Cash Converters as well. We might find that there'll be further upgrades to their earnings and to their valuations.
Go to our next call. I've got Anthony on the line from Adelaide. Anthony, welcome. What's your question tonight?
Oh, hi, Julia. Thanks for taking my call.
You're welcome.
I was just wondering if the panel could give me their thoughts on a company that I own. I purchased UXC shares around the $1 mark, and they seem to be doing okay, but I would really like the expert's opinion whether this could go on with it.
Yeah, what do you think, Roger?
Look, solid growth prospects, great cash flow, strong balance sheet, but not cheap, a little bit expensive, so not value for us. We need all those things to line up. And any investor thinking about UXC might want to consider it in the context of DWS and some of the alternative businesses that are out there.
Okay, so tell us a little bit about DWS and why you mentioned that stock.
We just think not internet businesses, but IT type businesses. You know, we think they're cyclical. We think they tend to perform best in the later part of the economic growth cycle, not in the early part. And the reason that is because many of their customers aren't willing to spend a lot of money in the early part of a recovery because they don't believe that it's going to last. And remember, we've just come out of a 5-year window where everyone was jumping at shadows. So there's going to be a lot of doubt and a lot of insecurity about this recovery in the economy, and so we probably won't see the results of these businesses improve for a couple of years.
Let's go to our next caller, and we've got Francis on the line. Francis, welcome. What's your question tonight?
Oh, hi. I'm ringing about Collection House. I bought it a couple of weeks ago at $1.17 and it reached $1.68 today. And I'm just wondering whether it's past Rogers filters. I mean, they announced this afternoon that they acquired yet another business and they seem to be on the acquisition trail. So they pay fully franked dividend. Is it worth holding on just for the dividends? Is it a good business? What do your gentlemen think?
Roger, what do you think?
I have to disagree with Michael on this one. We have been looking at it recently. It has now run up a little bit too far for us, Julia, so it's off the radar now. We're not as concerned about their debts because they're buying ledgers, and when they're purchasing ledgers, provided their collection rates are stable, they really know what they're paying for these things, and I think there's a very low risk of them paying back their liabilities. So we did look at it. We were really tempted to buy it. We didn't. We do own Credit Corp. We think Credit Corp is a superior business. The reason we looked at Collection House was because there was a little bit more value in it than was left in Credit Corp. But we own Credit Corp and still prefer to own it out of the two.
It's now the time for a break. But before that, time to start the stock watch. So Roger, what are you watching?
I'm a big fan of retail stocks. I think we're seeing a cyclical recovery in retail stocks, and a company that's going to benefit not only from the cyclical recovery but from a recovery in the Queensland floods is the Reject Shop. I think the Reject Shop will not only benefit as a result of opening the DC centre, the new DC in Queensland, but also it will benefit from the fact that it's just going to double the amount of stores that everyone thought it would open. So we're going to see a boost to EPS.
Welcome back to the program. If you've just joined us, Roger's stock watch was the Reject Shop, and it's a stock that's done extremely well over the last 52 weeks. The stock hitting 52-week highs, and I believe that a competitor of the Reject Shop has been taken out of the market, which is good news.
Yeah, so Jan Cameron, who was the founder of Kathmandu before she sold it to private equity, she set up a business called Chicken Feed and is doing some forestry work or some forestry rehabilitation down in Tasmania. But the Chicken Feed business hasn't gone very well, and some of the stores have closed down. The Reject Shop has, if you like, cherry-picked some of the stores around Australia that they liked, and they've renegotiated with the owners of those stores, the landlords, and they're tenanting those stores and they're going to set them up. So normally we would expect the Reject Shop to open maybe 18 stores in a year or something like that. They're going to open considerably more this year, and they become profitable reasonably quickly. The cash flow starts to come through, and so there'll be a boost to earnings per share, and that's why we've seen the share price recover. It's interesting when you look back over time, and if you're in the market for long enough, one of the things that you notice is the market and investors often treat temporary ailments as permanent. And they did that with the Reject Shop. So when it was on its lows, it was clearly good value. We knew eventually the DC in Queensland would restart. And the other problem was that their profits were absolutely hammered by the fact that they were distributing around Australia from one distribution centre in Melbourne. So it's going to be expensive. It's going to take longer to shelve the stock, put stock on the shelves around Australia when you've only got one distribution centre. Now the Queensland one's reopened and it's going very well. And so I think they're going to get a double whammy from those two events.
Let's go to our next caller. We've got Abe on the line from Sydney. Abe, welcome. Long time no hear.
Thank you, Julia, for taking my call. I'd like to ask the panel generally about energy stocks such as Oil Search, WPL, and Santos. In view of the strong demand from Asia, does the panel believe that these prices are sustainable? And what is the risk of cheap energy coming from the US because of the shale oil, flooding our markets, and how soon can that materialise?
I mean, Roger, looking at energy...
We've got a list of about 25 stocks in the resource space, be it gold or iron ore or hydrocarbons. Oil Search doesn't come up on that list, so that means either its growth profile is not attractive to us or we simply can't work it out, or it's expensive. So Abe, I have to tell you, it's not coming up on our lists at the moment.
Our next caller is from Sydney. Lindsay, welcome. What's your question for our panel tonight?
Oh, hi. Thanks for taking my call. A couple of weeks ago, I bought some Data shares, DDR, and they're up something like 20% in the last couple of weeks, and they seem to be on a very much expanding growth curve and looking good on the dividend side as well. So just wondering if the panel had a view on Data and if possible also on QBE.
Sure, so having a look at Data and QBE, let's start off with DDR. Having a look at the dividend yield, Lindsay, as you mentioned, it looks very attractive, 6.2%, and the share price has been running quite hard. So having a look at Data, and Roger, what are your thoughts on this one?
Well, for us, we did look at it and we noticed that it looked cheap and it was reasonably good quality. But for us, managing several $100 million, the liquidity is an issue, and we can't get enough stock to make it interesting for us. So it's not necessarily, that doesn't make it a bad investment for Lindsay, but it does mean we can't participate. It's just too small for us. In terms of QBE, gosh, how many years in a row have people said that the premium cycle was going to turn and we'd start seeing improvement in their outlooks? That hasn't happened yet. QBE's intrinsic value has been declining now for probably since 2007. And part of the reason for the disappointment is the fact that where they insure is by law where they have to actually keep a lot of their investments. Now QBE is very smart. They don't take any risk. They don't invest in equities. They invest in short-term bonds in the United States, particularly because that's where they do a lot of their insuring. And so as a result of that, they're getting very, very low rates of return on their investments. Now, what you want is you want a business that actually can make a profit out of its insurance side, but it can also make a profit from its investments. And it hasn't been making very high returns out of its investments. I think that's going to change. I think that'll start to change as interest rates start to head up. We've heard from the Federal Reserve Bank in the United States back in January that they said we're nearing the end of the period of maximum liquidity. We've seen 30-year bonds start to tick up. We've seen 10-year bonds start to tick up. What that means is interest rates will start to rise. That will be good for QBE. And as they transfer those profits back to Australia, if the Aussie dollar falls, that'll be doubly good for them. So there will be a point where they turn around and there's a sustained rally in the price and the value of the company. It just hasn't seemed to happen yet.